The interaction between providers of capital who have money and want to invest it, or savers who want to gain a return to benefit from compounding, and users of capital like companies and governments who are looking for capital or who want to take in capital and are able to offer a return, or who are trying to offer a return, and ideally will offer a return, is that interaction can take place in one of two forms. The first is through debt, and the second is through equity. And there are variations of each, but that's really more the detail. The fundamental interaction and the terms of interaction are either via lending money, which is debt, or via ownership, which is equity. And what does that mean? Well, it means that on the one hand, we have our providers of capital, and they can either lend money to users of capital, or they can take an ownership interest and own a part of that user of capital. And from the user of capital side, they can either borrow money via debt from the providers of capital, or they can take in owners and get money through equity capital from the providers of capital. So there are two fundamental ways in which the providers of capital, the savers and investors, can interact with the users of capital. The first is debt, lending, and the second is equity. Now, debt means lending and borrowing. So from the provider of capital standpoint, the debt is a loan, effectively, that is made to a user of capital. And as with all loans, there are certain terms attached to it, and these can vary. But typically, we're talking about an interest rate, we're talking about a return from the provider of capital standpoint that doesn't vary so much with how the company is doing under normal operating conditions. It has to do with more of an interest rate-like return or a fixed income return. From the company's standpoint, for example, or let's say more generally from the user of capital standpoint, it means sort of a defined outlay to have access to the capital. So let's say 7% a year. So the user of capital will pay 7% every year to the provider of capital. And those are the terms of the arrangement. And it doesn't really vary that much unless, either the company gets into extreme trouble and can no longer pay its debt, or the government gets into extreme trouble and can no longer pay into its debt, which in first world countries, including the US, is considered not to be a possibility, and therefore these loans are considered largely risk-free. So a government bond in the US is considered a risk-free investment. From the standpoint of default, I mean, there are other risks, but which may have to do with interest rate changes and so forth, but the terms of the interaction are defined by a certain interest rate typically, and let's say 7%. So the provider of capital expects to receive 7% on his money, and the provider of capital pays out 7%. And that's the first way that the two can interact: users of capital and providers of capital, or providers of capital and users of capital via debt, lending, and borrowing. The second way that providers of capital, i.e. savers and investors, can interact with users of capital, in this case, users of capital that are companies only, because governments can't have owners. The second way that, because it's a public entity, the second way that providers of capital and users of capital interact is through equity. What does that mean? Well, from the standpoint of the provider of capital, i.e. the saver and the investor, they're going to provide a certain amount of money, and they're going to take an ownership stake in the user of capital. They're going to take an ownership stake in that company. They can either take an ownership stake in that small company by, for example, paying a nominal amount of money, $50,000, say, to take an ownership stake in a restaurant of a neighbor, or they can take an ownership stake by providing a certain sum of money to buy a number of shares in a bigger company. But it is an ownership stake from the provider of capital's, i.e. the savers or investors standpoint. From the user of capital standpoint, they now have a new owner. That means, or they have an owner, which means that the owner is entitled to a portion of the profits of the business, and that owners, when new owners are taken in, the returns and the profits will have to be split with that new owner, and they will pay it. Typically, the owners have rights to whatever profits that business creates. In other words, instead of paying out 7% interest to a debt holder, the company now has an owner, and the owner is entitled to a portion of the profits of that business depending on the percentage of the business that he owns. So if he owns half the business, effectively half the assets and half the net income that's generated is effectively for him or her. So basically, the second way that providers of capital and users of capital can interact is via ownership, meaning that from the provider of capital standpoint, they're taking an ownership stake, and from the users of capital standpoint, they have an owner.